So they're monetizing the interest payments, which is pure debasement of currency. And debasement of currency means that the denominator, the purchasing power of that currency, goes down, and it makes the price of assets look like they're going up. But they're not really going up. And I discovered within that process that only two assets actually have risen versus the debasement of currency. That was technology stocks and crypto. Both were in secular uptrends. So this, like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the Bitcoin halving cycle.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discuss about Bitcoin and crypto. According to Raoul Pal, they are turning the interest payments into money, which is a clear case of debasement of currency and debasement of currencies, which means that the value of those currencies goes down, which makes the things may look like their prices are going up, but they're not really. You take something like the S&P 500, gold, or real estate and split it by the Fed balance sheet. They've been flat since 2008. And Raoul found that in process, that only two assets have actually gone up in value compared to the falling value of money. And those are technology stocks and secret code. Both were in long-term uptrends. So this business went off without a hitch cycle that is based on the debt. Refinancing cycle is the same as the US election cycle. It is the same as the Bitcoin harvesting cycle, which means that all of these cycles happen at the same time every time, and lots of things Raoul Pal discuss, so please watch the video to end. And share this video, and subscribe our channel, Everyday Finance. Thanks.
The world hit an inflection point in 2008, which was the global debt crisis. And we get the ramifications that spread on in 2012, the European crisis. And that continues to rumble on to this day. What happened back then was something remarkable. Is if we think about how GDP is created, the growth of economies, it's population growth, productivity, and debt growth. We've had aging populations in most of the Western world. The US is less aging than others, but still aging. But debt growth in 2008 stopped, basically. And we had a debt jubilee. Now, debt jubilees, most people would think of, you forgive all the debts. We didn't. We did this magic trick, which we said, you don't need to pay the interest on the debt. We'll make it all zero. And every central bank around the world cut interest rates to zero. Okay, that created an opportunity for every government to refinance their debts. So they all refinance, and they refinance them in this 3 to 5 year time horizon. And that set off a cyclicality to the economy that we've never really seen before, that every 4 years we get economic weakness, the increases of the balance sheet and use of interest rates as they come to refinance the debt. What I found out in my work that's become quite well known called the Everything Code, I found out that, in fact, the use of the central bank balance sheets was used to pay the interest on the debt from the previous cycle. And this will become relevant in a second. So they're monetizing the interest payments, which is pure debasement of currency. And debasement of currency means that the denominator, the purchasing power of that currency, goes down, and it makes the price of assets look like they're going up. But they're not really going up. When you divide, for example, the S&P 500 or gold or real estate by the Fed balance sheet, they've been flat since 2008. And I discovered within that process that only two assets actually have risen versus the debasement of currency. That was technology stocks and crypto. Both were in secular uptrends. So this, like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the US election cycle. It also happens to be exactly the same as the Bitcoin halving cycle. So all of these cycles are at the same time every time. So here we are today. Today, we're at the bottom of the business cycle. This is the kind of recessionary era. Businesses are laying off staff. inflation is starting to fall sharply.
According to Raoul Pal, the technology and crypto markets that looks to the future is paid in, They got out of the slump last year and have been getting better ever since by paying attention to the signs that point to the future of the economy and other things going on right now, like the Russell 2000 and oil is living in the present, which is a slow economy. So they're at as all hell. Everyone is wondering why tech stocks are going up while everything else is going down. It's because it's their job to look ahead. Raoul Pal have been very bullish since he saw the cash flow cycle, which is what all assets are driven by. The cycle of cash is built around this interest rate cycle, which is built around this whole debt. Last year, in October, November, and December, the refi cycle liquidity started to drop. This told us it was time to start buying crypto and tech. Let's back to the Raoul Pal interview.
The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. So they're at their lows. And everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December. And that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45% and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. That's when the weather kind of gets warmer every day, but sometimes it's raining and sometimes you've got a frost and other times it's hot and you're like, it's always confusing. That's macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing. And we should be in macro summer for all of 2024 and into 2025. And so my forward-looking basis is that the economy picks up, inflation keeps falling. I think it'll overshoot to the downside, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea, because we've just gone through a ridiculous rate cycle, kind of an unprecedented rate cycle on the back of the unprecedented inflation. That inflation, I think, was just driven by the pandemic. If you shut down all demand and shut down all supply and then bring it all back on at the same point, you create chaos. Exactly the same happened after World War II. After World War II, suddenly everyone came back into the labor force and factories had to retool from making munitions to making cars and washing machines and whatever. And we got a massive inflation then. But then what happened is it worked its way through and we just had strong growth going forward. So that's where we are today. So we've still got the problem remaining of that GDP formula. How do we pay for this bloody debt? Because it keeps going up. The higher interest rates go, the more bonds they have to issue, which is why I think they want to bring interest rates much lower than people expect by being so late in hiking, so they can undershoot and have the cover to paper over the cracks in the system yet again. And they'll use the commercial real estate and the banks as one of the excuses to do it, to start using the balance sheet. But we've still got the problems with the economy, is it's not growing fast enough to pay the interest on the debt. So if the economy on average is growing at 1.75%, and let's say interest payments on debt is about 2%, and the government's 100% of GDP in debt, that's all of GDP just to pay the debt. So what you need is to grow GDP. And to grow GDP, you either need the population to grow. Well, that's not going to happen. Or you need productivity to grow. That's technology. So productivity growth is what I'm really looking at. And it's not this cycle's story, but by 2030, we will see AI solve for both problems. AI and the robots are new demographics. They're new productive units in the workforce of infinite scale. So we can now have an infinite population of productive people in inverted commas, and that will start driving productivity. The next part of the equation is we need to bring the cost of energy per unit of output down. And it won't come out of fossil fuel markets, it'll come out of renewable energy plus nuclear energy. If you lower the cost, the average per dollar barrel of oil price over the last 60 years has been about $40, inflation adjusted. But if you change to a new source of energy or bring in other sources of energy to make an excess abundance of energy, and you bring it down to $10, that has a massive multiplier. So my big picture is we're about to go through an economic revolution, but we're not finished with the downside of slow economies, and that's going to mean more and more use of the balance sheets, ongoing increase in asset prices, and this ongoing cyclicality of the economy.
According to Raoul Pal, it's almost big summer time. What is macro summer? Macro summer is when people are interested in rates are going down since inflation is going down, and growth is picking up of the holy grail for both macro and micro investment. And we should be in macro summer for the whole of 2024 and into 2025. So Raoul Pal's view of the future is as soon as the economy starts to grow again, he thinks inflation will rise above the fall, which goes against what everyone else says about inflation being stuck. And he thinks the markets are because we just got through a crazy rate cycle, which kind of shows how excited they are about this idea. A rate cycle that has never been seen before because of the extraordinary inflation. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.